Assalamualaikum and good afternoons. We will continue with the next topic, continuations of the previous topic by looking at the behavior of the interest rate. This topic will touch on 4 selected subtopics related to behavior of interest, market interest rate, the liquidity preference frameworks, and the last one, the price level effects and expected inflation effects. First of all, let us look at what is the behavior of interest rates. As I have explained in the previous topic, an interest is the amounts of interest due per period as a proportion of the amount lent, deposited or borrowed. We also call it the principal sums. The total interest paid on a loan is determined by the principal amount, the interest rates, the compounding frequency, and the length of the times it is lent, deposited or borrowed. As we all know, money is the main source used and agent for lending in the banking system. It has a concept of buy, sells that it takes into account the interest rate that has been set by the bank. For that reason, an interest rate is a sum of money that a creditor receives from a borrower who lend money for a set period of time. The rate of interest rate is determined by the supply and demand in the loans capital markets and its status in the interest rate, which indicate the interest size relationships to the credit sum size. To summarize this, we understand that interest rate behavior is influenced by a variety of factors and can change as a result of them. The entire lines of interest rate is intimate interrelations with one another, which is growth of one financial instrument is impossible without growth of the other financial instrument, call it interest rate. There are 5 factors influencing the interest rate in the banking system. The first one is inflation levels, which is the degree of inflation. The central bank establishes its interest rates. Cheap money, which is the generates an excessive demand for the credit, creating the circumstances for banks, misuse and economic imbalance. The second one is the credit terms, which is an interest rate level is directly proportional to the credit terms. The longer the terms, the higher the interest rates will be charged to the borrower. The third one is the expenses for the formations of the loan capital, which is the cost of forming the loans. The higher the cost of banks' resources, the higher the average loan interest. The fourth is the credit size. The percentage for the large credit should be lower than for small credit because the cost of credit service are not proportional to the size. And the last one is demand for the credit, which is as the demand for credit grow, so does the interest rates on those credits. Why is there a need for interest rate in banking systems? These are the reasons why interest rate behavior is analyzed in the banking systems. In the reality, the interest rate is a leading economic indicator that serves as a benchmark for the cost of national currency. As a result, it provides a grasp of value of money. The central bank influences many economic indicators by changing the levels of the discount rates, inflation rates, and exchange rate when refinancing commercial banks. The level of interest rate charged by commercial banks has a direct impact on customers. They influence the rates of government debt security and the profitability of other financial instruments. These are the 3 reasons of why the interest rate forms in the banking system. The first one is supply and demand. Economic system is based on the premise that in exchange for the rights of borrowing money, which is bank lend the money and then you will pay a percentage known as a interest rates. The second one is monetary policy. Government like influencing interest rate directions by taking policies that tends to deflate or inflate borrowing costs. And the last one is inflation. Inflation reduces the purchasing power of money and can have a significant impact on interest rates. When inflation is served, so the lender would usually only lend money for extremely short periods of time unless a higher interest rate is attached. The increased rates is means to compensate them for the financial risk of lending money in an atmosphere where inflation could rise even higher. thereby diminishing the value of their money. Now let's take a look at the interest rate market that exists in our financial and banking systems. In banking system, there is a credit market. In this market, the interest rate is determined by the combinations of supply and demands of the money. Creditors are required to cut an interest rates, and as a result, to reduce the supply volume when there is an excess offer of the credits. When there is a shortage of borrowed funds, competitions among borrowers rises the interest rates and reduce demand value. This process continues until the market reaches a point where neither creditor nor borrower have any reasons to change their behavior. The curve shows the market balance or the market equilibriums in the credit markets. The market equilibriums will occur when the amounts that people are willing to buy, which is demand, equals the amounts that are people willing to sell, which is supply at a given price. The situation where BD is equal to BS. That conditions is the forms of the balance between price and interest rates for the bond markets. For the case of BD is greater than BS, it will show that the excess of demand price will increase and the interest rate will be fall. For these situations where BD is lesser than BS, it is found that the excess of the supply price will fall while the interest rate will be increased. These situations actually explains what happens if supply and demand occurs in the banking systems in the case of supply and demand for bonds. Equilibrium will prevail if the supply and demand for bonds are at the same level. There are 5 factors that will cause changes in the demand curve for bonds in the financial systems. It consists of wealth, expected returns, expected inflations, risk, and liquidity. You can find more information about this in the flipbook that have been provided. All of these factors will cause the curve of demand for bonds to move to the left or to the right depending on these factors. To make it easier to understand, this table shows the changes in the demand curve to the left or to the right depending on the following factors. From this table, we can see that there are 5 factors that influence the demands for bonds. What will happen if the wealth increase for bonds? So it will change the quantity for demands for bonds and it will shift the demands to the right. And expected interest rate, if it increase, it will decrease the quantity demands of the bond price. And we can see that the shift of the demand curve to the left. For the expected inflations, if its variables increase, so it will change the demand for bond price to the left, which shows that with the expected inflation, the demand for bond will be decreased. The riskiness of bond relative to other assets increase, it will decrease the demands of the bond price and it will change or shift the demand curve to the left. And liquidity of bond relative to other assets increase, it will increase the demands for the bond price and it will move or shift the demand curve to the right. Now, let us see what are the factors that influence the supply of bonds. There are 3 factors that influence the supply of bonds in the financial systems. There is the expected profitability of investments opportunities. The second one is expected inflations, and the last one is the government budget. The detailed information about these 3 factors you can find it in the flipbooks that have been provided, such as demand for bonds or the factors that affect the supply of this bond will also cause the supply curve to shift to the right or to the left. Well, this is just the first parts of this topic. We will connect with the second parts in the following description video. The detailed information about this part can be found in the flipbook provided. Thank you.